Hello guys, my name is Moshir Ansari and today we are going to analyze Castrol, Castrol company or stocks. So basically it is a large cap stock. We are going to analyze it is technicals and fundamentals too. So let's start with this technical Castrol Limited, right? So basically, so as we know that it is a lubricants related company that's for lubricants to for the automobiles and bikes and all. First, let's analyze it is technicals, then go with the fundamentals, right? Where we will be seeing what the company does and all. So basically, as we can see that the company's market it is all time high up to we can say 270, right? And then again it went up to 270 in first August 224, and then it was acted as a resistance, and then it fall back, and now it is trading around 30% below from it is all time high, right? So basically the company is trading at lower prices compared to it was trading before that. And let's go with the fundamentals. So let me search. So as we can see that Castrol India Limited is a small cap company. Basically it is a small cap company because it is having a market cap of around 20,000 crores. Castrol India Limited principally engaged in the business of manufacturing and marketing of automobile and industrial lubricants and related products, right? So let's see, is it Dasify or it is just, oh sorry, looks like I don't have premium, that's why they cannot show me the all key points because I have already reached the limit. So let's go with the ratios first. Stock is pays 20 and industry pays 13. That's so that is quite little bit high. We can say that return on capital employed and return on equity. Return on capital employed is high and return on equity is low. That shows the company might be having little debt, not that much. As we can see that debt to equity ratio is 0.04. Promoter holding is 51% and there is no change in the promoter holding in the 3 years. That's good sign. Interest coverage ratio is high because they have very less interest obligation. EPS growth for the 5 years is only 2.14%, and for the 10 years 6.83%. That's quite very low, and quick ratio is 1.16 and current ratio is 1.61. That's good because quick ratio is 1.16, that we can say above the standard of 1, and there is a less inventory we can say because the inventory is around 50.50. That's quite acceptable. Book value is 18 and the current market price is 200 around. That means 10 times of book value is current market price is 10 times as compared to its book value. That's acceptable. If we no, sorry for that, that's not acceptable because if we compare with it is industry book value, it is only 2.53. So that shows that the Castrol is trading much more higher as compared to it is industry, it is peers, right? And sales growth for the 5 years is also low, and the APS for the 10 years already we have checked that it is low. Average dividend payout is quite we can say 100%, not 101%, because no company can pay more than they earn, right? So dividend yield is quite high, 4.3 or 4.31%, because as we can see that they are not doing good sales, so that's why maybe they are paying high dividend to attract the more investors. EV to EBITDA is quite acceptable, 13, and the PEG ratio is quite high. It should be around 1 and 1.23, not the 3. So it's also high. So overall ratios show that the company is quite not efficient because the company is not able to generate sales, or not either they are not able to improve their overall margin so that they can increase the APS. So it is not acceptable. So let's check it is trend over the years P and APS. So basically in 2014 Jan 2014, company was having a 31 P and with a EPS of 5 around. Now company is having a 21 P and EPS of 9.6. So that shows that the company is quite undervalued if we compare the trend, right? So as we can see that, let's compare with the utility peers, oil, gas and consumption fuels, petroleum products, right, lubricants. So as we can see that the company is one of the highest market cap, one of the highest, not it is the highest. It is having a highest market cap if we compare with the lubricants, other lubricants manufacturers. And the quarterly sales variance, we can see that all the companies are not doing well, and the PEG ratio is quite. If we compare with the industry peers, that we can see that it is quite high, and the EPS for the 12 months also quite low. Sales variance for the 5 years is quite also low, and the profit margin for the 5 years also low. If we compare with the peers, and current market price to the book value is high, that's bad sign. EV to EBITDA is also high if we compare with the industry average. Current market price to the sales also high. Return on equity and return on capital employed is good, and PE also high. So overall, the Castrol India is showing the high at a higher valuation if we compare with its peers by using the ratios. Okay, so let's see why the market is giving the Castrol India Private Limited high valuation, even thought it is not doing well. Maybe it can be because of it has a feature good feature growth, so that market is pricing in that in. So as we can see that within 3 years from 1250 to 1400, it is not quite good, we can say that. Look at that, year on year sales growth, it is like they are doing nothing. Look like lubricants oil is not any more requirement for any automobiles, but as we know that it is a requirement, but why I don't know. It is sales is going downward, maybe because of the competition and all. So operating profit margins, we can see that it's quite fluctuating, but it is remain at like 22, and they are not able to efficiently utilize their expenses, I think, as we can observe from here. It is also fluctuating, but we can say that it is stagnant at 51%. Interest obligation remains same, and other income, maybe they have some FDs or investment through which they are generating some revenue. So sales growth for the let's analyze the profit and loss statement or income statement. So sales growth over the years, like from the 2013 to 24, as we can see that it is not a significant, even they are not able to double the sales. Look at that, it is being positive, but it is not good. It is hardly growing, so it is not good. Their expenses, so material costs remain the, it is quite material cost, they are not efficiently able to utilize that, because it is the main component that can help to improve the margin, operating profit margin, but they are not efficiently able to manage that, right? Manufacturing costs remain stagnant, and employee costs have been increased, right? Other costs also remain constant. That's why operating profit margin is remain stagnant. So overall, company is not doing well till now. Let's see the balance sheet. Balance sheet shows that the uh, promoters are not diluting their holding in the company. Reserves have been increasing over there. That's good. Borrowings, there is very less borrowing, and all the borrowings are from the lease liability, I think, as we can observe. Fixed assets have been high, very slightly increasing. That's not a good increase. We cannot say that they are actually investing for the fixed assets. And capital work in progress is good. Maybe they have some capital which is in work in progress, right? Investment. They are doing good investment here. We can observe that within 3 years they have done good investment. Let's analyze the cash flow. Let's see the first 900, 900, 1800, and around 3000 crore. they have generated within 3 years, right? So 3000, so I think no, as per the observation we can say that they are uh, collecting the cash after the sales. They are not just doing the credit sales. That's good sign for the company. Cash, they are hardly purchasing any assets, we can see that. And they are as we observe that within 3 years they have made good investment, and they are actually paying the dividends. As we can observe that interest paid obligation of ratio analysis. Debtor days, as we can see that the debtor days remains stagnant. There is no improvement in that, and inventory days have been quite also stagnant. Days payable days also been stagnant. Overall cash conversion cycle is quite low. That's good sign that the net working capital is not tapped in the business. That's good sign for the company. Promoters holding remains stagnant over the years. That's good. FII is also being stagnant here, and DI has also DI has slightly reduced their stake from 16% to the 15%. So overall, the company is not doing well. If you want, first of all, I am not a SEBI registered researcher analyst, but if you want my recommendation, I will say that the company is not doing good. Company's business is quite stagnant for the over 10 years. That's very bad sign for any company. Either they have lose market share, or either they have to improve their market share, right? But they are doing nothing. Looks like they are doing nothing. There is a requirement for the lubricants for the automobiles, but I don't know why they are not able to generate profits out of it. You as you can see that company is trading at the same level when it was trading at the 5 years ago, 10 years ago, right? So I think it is not a good investment for anyone. So I think we have to drop this stock. Thank you for very much for watching. Have a nice day.